Let's get to the Bank of America Merrill Lynch survey, shall we? Delivering the key trends in global markets in its fund manager survey for the month of May, with opinions and insight from 200 institutional, mutual and hedge fund managers from around the world. Investors hedging against risk as the threat of a trade war looms. That's the takeaway. Let's bring in Jared Woodard, shall we? Bank of America Merrill Lynch global investment strategist. He joins us now. Jared, great to catch up with you. This line jumps out to me. Not enough fear to buy, not enough greed to sell. Walk us through it.
Yeah, thanks, John. I'm glad to see you. The first takeaway, I think, which you already mentioned, is that investors were pretty well prepared for a lot of this trade friction, coming into the end of last week and this week. We saw in the survey that, a record 34% of investors told us that they were buying protection. They were buying hedges, options, et cetera, to protect their portfolio in the event of a trade war. You can see that we noted last week, a huge spread between implied volatility in S&P options versus the actual volatility of the market. What that tells us is that investors were ready for the kind of friction with these that we've seen. I think that's why, even on some fairly dramatic headlines, the market response has not been as bad as it could have been. That's the good news. The bad news is no one's ready for a really prolonged, protracted, really deep fight and the kind of recession risk and growth concerns that would bring. You saw this month, investors actually adding to European equities. You saw profit expectations jump to a 9-month high. There were a lot of responses in this survey that showed us investors still in a stagnation mindset, but we're actually taking on a little bit more risk and certainly aren't ready for a really long, protracted fight. That's something that, if you're betting against the president's resolve on this issue the last 2 years, you've actually done really poorly to kind of make that assumption. I think we've seen that in the last 5 days. And investors aren't quite there yet in terms of the risk of a prolonged trade war.
So, Jared, just in terms of investors leaning against what have been crowded trades in this survey over the last number of months, the long US tech story, the short European equity story being the top two, have you found over the last couple of weeks that going into this mess, some people were leaning against that short European stocks story and starting to buy into the idea that things would pick up just at the wrong time?
Absolutely. I mean, the narrative was that we're going to have green shoots, that China is stimulating, that it's time for a cyclical rebound. We've seen that in the past 10 years on several occasions. What happened this time, what was different this time, is that China made a really concerted effort to keep its stimulus bottled up inside their domestic economy. So Chinese real estate, shot higher. Real estate stocks there shot higher. What you didn't see was the benefit and the boost to the rest of the global economy, especially in trade and cyclicals. That's above all else, European manufacturing, German manufacturing, and if you look at PMI data or other macro data recently, you haven't seen the kind of rebound that people were hoping for. That's why you get such a sell-off, the last few sessions in tech, in high beta, in small caps, all the things that would be poised to benefit from a cyclical rebound. So far, it looks like the China stimulus, ain't it.
So, Jared, interesting question, an interesting answer coming from this survey. Where the strike price is for the Fed put, and what I see in this survey is it's a whole lot lower than where we are now.
Yeah, I think the Fed, that's a response to, some fairly clear communication from the Fed that, the balanced view, that risks are transitory, et cetera. They don't expect a hike, but they don't expect, the Fed to come to the rescue either without some real market pain. The silver lining to this, I think, is investors are also not expecting, a huge rally in bonds and a plunge in yields to record low. We saw, just 4% expect Treasury yields below, 2% in the medium term. So again, it's a kind of the bad news is there's not enough fear to buy. There's also not enough greed to sell, and so you're left kind of waiting with the portfolio that you have. Hedges are now expensive, and you kind of have to wait and to get some macro clarity before I think you can make a big move.
So, Jared, what's the advice from you guys outside of the survey? You take that as a reference point. What's the conviction call from you guys? To do nothing, just sit tight?
Three things to watch, three things that'll tell you, I think, when it's time to take on some more risk. Our bull and bear indicators at 5.1, that's almost perfectly neutral on a 0 to 10 scale. What you need to see to motivate an action are the 3 C's, we call them. That's credit, China, and commodities. The big movement in China, and especially Chinese domestic economy, is, I think, extremely important. Auto sales still plunging. You need more stabilization there. But even more important, I think, is the U.S. consumer. Retail sales data coming up is going to be extremely important. And if you can see that the U.S. consumer is resilient in the face of all this friction, I think that gives you confidence, to buy. And if we see a test of the 200-day moving average in the S&P, I think that's worth taking a buy on as well.